Hello everybody, and welcome back to our YouTube channel.
In the previous video we talked about the stock market, but now it's time to talk a little bit more about stocks.
And more importantly, how to pick the right ones. Now there are plenty of different ways that you can look into a stock or a company. You can look at the PE ratio, you can look at the capital growth, or the annual return every year, the dividend yield. You can look at the average volume or even just the price of the share. Now, as an investor, I recommend you do not one of these things, but all of them. It's important to do your research before you buy any stock and look into any company before you buy it.
So let's get started and look into what a PE ratio is. So the PE ratio is basically the price to earnings ratio.
This is the amount of money that the company makes versus the actual share price. A high PE ratio could indicate that a lot of investors have noticed a lot of return from the company and have bought it, raising its share price. A high PE ratio can indicate that a stock is currently overvalued or a bad time to buy. A low PE ratio means the opposite. A stock may be making a lot of money and not a lot of investors have bought into the share yet, and it could be a good time for you to buy if that company is making good earnings. This could also be known as an undervalued company when the PE ratio is low. Keep in mind that irregardless of whether the PE ratio is high or low, it is always just one indicator of whether or not you should buy the stock. Invest with caution. But keep in mind, these are all still indicators and not clear, definitive reasons to purchase a stock. Always do more research.
So another thing to look for when picking a stock is annual growth.
The annual growth is important because if a company is growing by 7% each year consistently for 5 to 10 years, this can be a clear indicator for a very good company to buy into. Companies like Disney, Coca-Cola, and Microsoft have seen some very phenomenal annual growth year after year. Keep in mind that the stock market averages a return of about 7% each year. So a company with an annual growth of about 5% or higher is generally pretty good. Now, let's talk about my favorite part of investing and the reason why I started investing in the very beginning.
Dividends.
Dividends are basically cash payouts to investors, shareholders of a company, just for buying into their stock. That's right, a company will pay you simply for buying their stock. Now, it's important to know that not all companies pay dividends. Some of them don't, some of them do. Also, keep in mind that inflation rises each year, on average, by about 2%. So if you are looking for a dividend company to invest in, it's good to look for something that pays at least more than 2%, or else you'll just be losing money to inflation. Companies that normally pay dividends might not have as much capital growth as a company that offers no dividend. This is because a company that's paying out money to its shareholders won't have as much money as a company that doesn't pay money to its shareholders to grow their own business. Okay, so let's look at a company and we can figure out how to find all the information that we talked about previously. So we're going to go to Google and we're going to type in Google Finance. It'll pop right up. Click Google Finance, hit the first link that comes up, and you'll be taken to basically a website that shows you all of the stocks you could possibly find within the stock exchange for basically almost anywhere in the United States, and even some international companies as well you might be able to find here. So let's look up Apple. It's a great company to start in. Here you can see the name of the company is Apple. You have the ticker symbol AAPL. That's basically the symbol that you'll type in to find the company. When we hit Apple, we can see here in this chart its daily price fluctuations. What we're going to go ahead and do is we're going to hit the 5-year annual returns, and this will basically show us over the last 5 years how the company did as a whole. As you can see here, the company starts out pretty low, down in 2017 at about almost $30. Let's check that out. Yep, about $26 right here up until 2017, and we get to about $28. Yeah, just under $30. But as this year goes on and into the next year in 2018, we can see that the company has continuous growth. If we look at the max return of Apple, we can see that it has grown consistently over time. This is a very good piece of information because it shows that the fundamentals of Apple are very stable. This would make a great investment. If we scroll down, we can see a whole range of information that we talked about previously, such as the PE ratio and the dividend yield. We have a PE ratio of 40, which is a little bit high. I would shoot for a PE ratio of around 20, maybe 25 to 30 is even good. But I told you before, PE ratio could mean that the price is overvalued. We might want to wait for the share of Apple to go down a little bit before we start making any big investments. Also, we see the dividend yield of 0.63. That is not very good because inflation is at 2%, and for this as a dividend income might not be the best choice because we'd still be losing money to inflation each year. But all in all, that's how you find that simple piece of information. If we type in another company, for example, let's try this one right here. If we hit the max returns, you can see the exact opposite here from Apple. This might be a riskier investment option. Not to say that it'll be a bad one, but it'll be a riskier investment option as the price is continuously decreasing over time. You want to be careful of things like this. Do your own due diligence and your own research, as this company might not go back up over time.
So to recap,
we talked about the PE ratio, where to find it. We talked about capital growth, annual growth, and dividend yield, and how to find those as well.
if you learned anything, hit that like button. Always subscribe. Tell your friends, tell your family.
In the next video, we'll talk more about stocks. We're going to talk about dollar cost averaging. We'll talk about the average volume of a stock. And we'll talk about market capitalization, because that's all important information that you need to do and research that you need to do when making an investment.
See you in the next video, guys.
See you in the next video.